We have been doing the perpetual inventory system so far. Now we're going to spend a little bit of time talking about the periodic inventory system. Some key differences, periodic and perpetual. The number one difference, what does perpetual mean? Constantly, all the time, perpetually ongoing. With the perpetual inventory system, we constantly updated merchandise inventory. That account was always up to date in our books. Remember, whenever we bought inventory, we debited merchandise inventory. When we returned inventory, we took it out of merchandise inventory. When we sold inventory, we took it out of inventory. Our inventory account was always up to date. With a periodic system, our inventory account is never up to date except at the very end of the period. Instead, when we buy something, it doesn't go into merchandise inventory. It goes into a new account called purchases. If I send it back, it doesn't come out of inventory. It goes into a new account called purchase, returns, and allowances. We don't touch merchandise inventory for those transactions. When we sell something, we only make the first journal entry to record the sale. We don't make the second entry. Same thing when a customer brings something back to us. We make the first entry only, the revenue portion only. We don't make that entry to update inventory. In other words, we can't touch merchandise inventory at all during the period with a periodic inventory system. As a result, we never know how much inventory we should have on hand. Remember, with a perpetual system, we always could tell how much inventory we should have on hand. That didn't guarantee that we actually would have that much, but we knew how much we should have. Periodic system, we have no idea at any point in time how much inventory we should have on hand. Let's compare our journal entries. Now, I put the ones for the perpetual inventory system up there. I'm going to mention how they're going to look in periodic, and you're going to see we have lots and lots of new accounts. When we buy merchandise from a vendor, we don't debit merchandise inventory. We debit a new account called purchases. When we pay the freight cost to have goods delivered to us, we don't debit merchandise inventory. We debit a new account called transportation in, sometimes called freight in. If we sent merchandise back to a vendor, with a perpetual system, we'd credit merchandise inventory. Periodic system, we credit another new account called purchase, returns, and allowances. 3 new accounts there already. We pay within the discount period. Notice with the perpetual inventory system, the discount that you take goes to merchandise inventory. With a periodic system, that discount goes to an account called purchase discounts. Notice right at this point, have we touched merchandise inventory at all? No, we will not at all during the period. Instead, we have a new account for purchases, one for purchase discounts, one for purchase returns and allowances, and one for transportation in. Now, the next 2 steps are where life gets easier though. Remember, with a perpetual inventory system, when you make a sale, it takes not 1 but 2 journal entries. The first one to record the revenue, the second one to update inventory. With a periodic system, we make the first entry only. We don't make that second entry at all. We do not make that entry debiting cost of goods sold and crediting merchandise inventory. Let's pause right there and talk about why we don't do that. We said years ago nobody did it this way, right? The perpetual system, everybody used periodic instead. To make that second entry, debiting cost of goods sold and crediting merchandise inventory, you have to track exactly what you just sold. Until the advent of computers and scanning and barcodes, could companies easily track what they just sold? No, they couldn't. It was not possible. No second entry is made then. Customer brings something back to us. The first entry is to record the return. The second entry is to update the inventory records in a perpetual system. But with a periodic system, we make the first entry on. So recording revenue and recording customers' returns really are much easier now. The key differences: we don't touch merchandise inventory at all. Buy something, it goes into purchases. Send it back, it goes into purchase returns allowances. Pay the freight cost, it goes into transportation in. Take the discount goes to purchase discount. So any transaction that used to affect merchandise inventory has got to go to a new account now. We've got to have a new place for it. The easy part is when we make a sale, we record the revenue only. We don't make that second entry to update inventory. When the customer brings something back to us, again, we record the return only. We do not update our inventory. So the balance in merchandise inventory doesn't change during the period. Doesn't change during the end of the period at all. Till the end of the period. And actually my closing entries then become more complex. We're not going to talk about that. But in my closing entries, basically I also have to take the beginning inventory off my books put the ending inventory on my books. We're not going to cover that though. Let's make some journal entries. Now we're going to be buyer and seller. Now we're going to do these periodic. As we do them periodic, I'm going to stop and ask you the question, what would that look like perpetual? So I want us to think perpetual and then make them periodic. We're going to buy from Yoda 10 lightsabers, $400 each, 210 net 30, FOB shipping point. Lightsabers cost Yoda $250 each. Now we are the buyer. We're buying these to resell. Periodic inventory system. If it was perpetual, under a perpetual system, what would the buyer debit? Merchandise inventory. But can we do that under periodic? No. Instead, we debit what account instead? Purchases. A new account called purchases. I'm still going to credit accounts payable. So we can't debit merchandise inventory. Instead, we debit purchases. The seller. What did the entry look like on the seller's books with a perpetual inventory? How about the first entry? Debit what? Accounts receivable, good. Credit what? Sales, very good. That entry is not going to change. However, under a perpetual system, we would have also made a second entry that would have included a debit to what? Cost of merchandise sold, good, and a credit to what? Merchandise inventory. Periodic system, there is no second entry. See how life is simpler for the seller? Just got to make one journal entry for the revenue. I'd be keeping up with the revenue. That's not the hard part. Darth Vader sends back 2 lightsabers. 2 lightsabers. Hasn't paid for them yet. What am I going to debit if I'm the buyer returning those? What am I going to debit? Accounts payable, good. Why? To make the liability go down. Now, if this was a perpetual inventory system, what would I credit? Perpetual. Good. I would credit merchandise inventory. Good. Why? To make the asset go down. But periodic system, I can't do that. Instead, what account do I credit in its place? Purchase, returns, and allowance. Because we can't touch merchandise inventory. How about in the seller's books? We got to reduce the amount that that customer owes me. What is the seller going to debit? Debit sales, returns, and allowance is good. What will we credit? The asset go down, credit accounts receivable. Debit sales R&A, credit accounts receivable. Now, if this were a perpetual system, we would make a second entry that debited what? Merchandise inventory, very good, and credited what? Cost of merchandise sold. We don't make that entry. The appropriate party pays the freight bill. FOB shipping point. Who's responsible for the freight if it's FOB shipping point? The buyer. Perpetual system. What would the buyer debit for the freight cost? Merchandise inventory. That's one that students don't like. I told you, that's one that students don't like. They would debit merchandise inventory if it was perpetual system. We don't physically have more inventory, but did the cost of my inventory go up? Well, it did, because I had to pay to get the goods to me. We can't touch merchandise inventory, periodic system. What do we debit instead? Transportation in, or freight in. I don't care what you call it. Freight's a shorter word. I'd probably use that. Darth Vader pays Yoda on day 10. How much does he owe? Well, let's see. $4,000 to begin with. Sent back $800. He goes $3,200. He can take what percent discount if he pays on day 10? 2%. Says he can pay $3,136. If these numbers sound familiar, it's because we've used them in the previous example earlier in this handout. What does the buyer need to debit when they make this payment? Accounts payable. Good. Makes the liability go down. How much do we need to make the liability go down by? $3,200. Get the liability off my books, because that's what it's on my books for right now. I need to make it go down by that amount. What does the buyer credit when they make the payment? Cash. How much cash did they pay? $3,136. Now, to make it balance, I need a credit for $64. Let's go back to perpetual system first. Perpetual system, what account would I credit for the $64? Merchandise inventory. I heard sales discounts, but only the seller can use sales discounts. That's your trick to remember that. Perpetual system would credit merchandise inventory. But we can't touch merchandise inventory in a periodic system. Instead, we credit a new account called purchase discounts. We're not going to do closing entries for a periodic system. They're much more complicated. Can you see why right now we got 4 new accounts we got to close out to begin with? We have purchases, purchase terms and allowances, purchase discounts, transportation in. All those have to be closed out. We don't have cost of goods sold anymore, so we don't have to close that one out though. On the seller's books, what does the seller debit when the customer pays it? Cash, $3,136. Let's talk about the credit next. We'll come back to the other debit. What account do I need to credit? Receivables on my books for how much? $3,200. I need to take it off my books for $3,200. To make it balance, my $64 gets debited to sales discounts. So the changes on the seller's books aren't as dramatic as they are on the buyer's books. Really, the seller's life just gets a lot easier. When they make a sale, they record 1 entry, not 2. When the customer brings goods back to them, they record one entry, not two. Other than that, the seller's books are just the same. The buyer has all these new accounts, though. Let's pick up cost of goods sold here. In a perpetual system, every time we make a sale, we figure the cost of what we just sold. Remember, we make that journal entry, debiting cost of goods sold, crediting merchandise inventory. Periodic system, we don't do that. We don't know how much inventory we should have on hand. Our books are never up to date. We still, for the period, need to know cost of goods sold. For the periodic inventory system, then, we have a formula we are going to use to calculate cost of goods sold. That formula can be used only at the end of the accounting period after I go out there and physically count my inventory. So under both periodic and perpetual systems, you have to count your inventory, but really for two different reasons. Perpetual system, you count your inventory at the end of the period to see if you really have what you're supposed to have. Periodic system, you go out there and count it because you have no idea what your cost of goods sold is or how much inventory you have on hand. You can't figure cost of goods sold until you count your inventory first. We have a formula for it. Before we talk about that formula, let's talk about candy bars, but I think being that this is Fair Week, we should talk about funnel cakes. I have 10 elephant ears to start the day off. I buy 20 more. At the end of the day or the month, there are 6 left. How many elephant ears did I eat? 10 plus 20 says the most elephant ears you could have eaten if you ate them all would be what, 30? But there's 6 left. So 30 minus 6 says you must have eaten 24. That's the formula we're going to use. What I just told you about elephant ears is what we're going to put in a fancier form here for a periodic system. The formula has kind of 2 pieces. One leads into the other, but here's the skeleton version. It says the beginning inventory, which was 10 elephant ears for us, plus the cost of what we buy, which is 20 elephant ears for us, is the cost of what's available, which is 30 elephant ears, minus the ending inventory, which is the 6 elephant ears, says the cost of merchandise sold then is 24. But we didn't sell it, we ate it with its elephant ears, but nonetheless, it's the same thing. Beginning inventory plus what we buy is what's available, minus what's left is what we ate or what we sold. That's our formula. You just did it in your head before I even told you that formula. There's a sentence if you need that. Okay. That's appropriate for Fair Week. Big pigs are extra smelly. Now there's only one part of that we need to talk about, and that is cost of merchandise purchase. I made it really simple a minute ago. I said 10 elephant ears, but we need to be talking in terms of dollars. We're going to calculate that figure. I want you to look right now at these 4 lines only. Purchases minus purchase discounts minus purchase returns and allowances equals net purchases. Can you tell me if that looks suspiciously like something else we just talked about? Where we figure net sales, isn't it? How do we figure net sales? We took the gross or total, we subtracted the returns and allowances and the discounts to get the net. So if you know how to figure net sales, isn't it pretty easy to figure out how to get net purchases? The total minus purchase returns and allowances minus purchase discounts is net purchases. There's just one other complicated factor we have to pick up, and that is down here at the bottom. We have to add in the freight in or the transportation in. But I want you to see how this portion of the formula looks just like figuring net sales. And once we figure the cost of what we bought, we drop it in here. So the actual statement meshes both of those together, but I think the way to learn it is 2 separate formulas, and then you mesh them together. And there's another sentence if you need that. Here's an example of a cost of goods sold statement. My beginning inventory. And next I need to calculate what I bought. Here's my purchases minus returns and allowances and discounts is my net purchases, plus the freight to get them to me says I bought a total of 87 overall. I had 10 to begin with, which means I had 97 available then. Deduct what's left, and that's the cost of what I sold. Let's do an example. I've given you some data. Let's calculate the cost of goods sold in this example now. First off, my beginning inventory. Now I'm going to write merchandise inventory, comma, and then the beginning date. In this case, this is for the fiscal year that begins on July 1st and ends on June 30th. So I had 6,300 to begin with. Plus I need to add in the net amount of what I bought. And that's something I have to calculate, the net overall amount of what I bought. To do so, I'm going to start with my purchases and subtract 2 things from them, returns and allowances and discounts. My R&A were $250, my discounts were $850. I need to subtract a total of $1,100. $1,100 from the $12,000 says my net purchases are $10,900. Almost the number I need, but not quite. We need to add in my freight in, or transportation in, and that will give me the overall cost of what I purchased. So I had $6,300 to begin the year. I bought in total $11,500. That's a calculated figure. It's what I bought, minus the returns and allowances and the discounts, plus the freight cost to get them delivered to me. I had $6,300. I bought $11,500. If I had sold everything, I could have sold merchandise that cost me $17,800. Did I sell everything? No. How do I know I didn't sell everything? I had some left. At the end of the year, I had $4,100 worth left. I could have sold $17,800, but there's $4,100 left. How much did I actually sell? Well, $13,700. I would then take that $13,700 and drop it in on my income statement, subtract it from my net sales to gross profit. So remember, with the perpetual inventory system, cost of goods sold was just an account in the general ledger. I updated that account every time I sold something. Now I simply calculate cost of goods sold in total for the entire period at the end of the period after I count my inventory. Because this ending inventory figure right here, I have no idea what it is till I go out there and account. So I have to count my inventory first before I can go into making this calculation for cost of goods sold. That's a great question. When this question was, how do they figure inventory shrinkage? The assumption is, if it's not out there in ending inventory, you must have sold it. You must have sold it. Now, really, did you sell all $13,700? Probably not. Probably some of it got stolen, probably, but you have no idea. Now, I say that. There's a topic we used to cover in accounting principles we don't cover anymore called estimating ending inventory. There are some ways that you can estimate with the periodic system how much ending inventory you should have on hand, and then compare it to a physical count. You know, it's an estimate. So that's a great point. Remember, we said controls are much worse than a periodic system. You don't know how much inventory you should have on hand. You've got to assume that you sold all that stuff. You don't know what a problem you have with inventory shrinkage. You might have a big problem, maybe you don't.